traders and investors, welcome back to the Trend Trader channel. So in today's video, I want us to talk about a tax-free savings account. As you know that I'm using Easy Equities as my broker. So in this context of this video, we are talking about tax-free savings account that you can find in any other broker, but if you're using on Easy Equities, you know that in our TFSA, we only have access to exchange traded funds, which are called as ETFs in short, right? So we know now that we are coming to the end of the 2021-2022 tax year. So we were given an opportunity to invest a maximum of 36,000 into our tax-free savings account. So congratulations to everyone that managed to invest that 36,000. But we know the country how it is. Not everyone is going to afford to invest that amount of money. So even if you didn't max it out, congratulations that at least you took that initiative to invest in your future, right? So why tax-free savings account? There are some benefits in investing in a TFSA. One of the benefits is that if you make profit, you're not going to pay capital gain tax on your profit, right? And also you can actively trade in and out of the positions, even though it's not something that I can recommend for everyone. But for those that actively manage their portfolios, you don't have to worry about a large tax bill from SARS. That is why we invest in a tax-free savings account. Remember, for the 2021-2022 tax year, the maximum that we could invest was 36,000. Well, I missed the budget speech, but I didn't see anyone on social media commenting if that value had changed. So I'm assuming that we can still invest up to 36,000 for the 2022-2023 tax year, right? So at least now you know the benefit of investing in a tax-free savings account. Make sure that you don't take a tax-free savings account with a bank, because banks don't have the proper product. If you put money in a savings account, how much interest they're going to get, and the inflation where we are, right? So ETFs are a better option compared to putting your money in a savings account with a bank, right? So now let's talk about my tax-free savings account. Where am I invested, right? Remember, I said I'm using Easy Equities, so I'm only invested in ETFs, but I don't own a lot of ETFs. I try not to over diversify my portfolio. So since we trade in the Johannesburg Securities Exchange, our general market, you could either track the JSE Top 40 Index, which is just the 40 largest companies by market capitalization. And then recently, Satrix introduced an all-share capped ETF that tracks all the companies that are in the JSE, but they are capped to a maximum of 10%, right? So that is just the difference there, besides the total expense ratio, depending on the ETF provider that you are using, right? So in my portfolio, I have 40% of my funds invested in the Satrix Top 40 ETF. The reason why I chose Satrix over the other ETF providers is the total expense ratio. It's 0.1%, so it is relatively cheap compared to other ETF providers. It gives me exposure to the top 40 companies that you can find in the JSE. It also distributes distributions every quarter: March, June, September, and December. Then I can expect to receive something there, but I do not withdraw my distributions. I reinvest them in the market so that I can compound my gains, right? But like I said, Satrix has introduced that all share capped index ETF. I'm also toying about the idea of adding that ETF into my portfolio. The benefit of that all share capped is that you get exposure to all the companies, including the small and mid caps that are outside the top 40, plus that ETF it distributes every 2 months from February moving all the way up. I won't try to remember all those months, but now the difference at this moment, the proposed total expense ratio for the all share capped index ETF is 0.25. It's a bit higher compared to the Satrix Top 40, but I mean, it's more work that needs to be done there, because it's over 300 companies compared to 40 companies that you can only find in the top 40 ETF, right? So that's the first ETF. But remember, this is just the top 40 ETF. It is a general market ETF. So what you can expect to get there is to get the average result from the market itself. But I prefer exceptional result even when I can get them. So that is why I also look at sector specific ETFs. By sector specific, I mean that ETFs that tracks other sectors. It could be property ETF, resources, or financials. And like I mentioned, those are the three sector ETFs that I have in my portfolio. I have a position in One Vest Property ETF. I also have a position in Satrix RESI, which tracks the resources sector, which has done very well in the past. This week, we saw a lot of great results coming from the mining companies. So, who wouldn't want to have a position in that sector? And then lastly, I have a position in the Satrix Financials ETF. I think that has about 15 financials or so. So we know that the banks have done incredibly well in the past, but it's not just the banks. Some companies like insurance companies, they also fall under financials, right? So I have those three ETFs in addition to the Satrix top 40. So all these other three ETF, I have about 20% of my capital allocated to each ETF. What I don't have in my portfolio is a foreign ETF, like for example, an ETF that tracks either the New York Security Exchange or any other exchange that is outside South Africa. The reason for it is because I do have those ETFs in my USD account. I understand that by not having those ETFs in my TFSA, I can miss out on their performance. That is understandable. It's something that I'm aware of, and that can lead to underperformance. For example, there was a time where the Nasdaq or S&P 500 ETF outperformed the GSE. So that was the best time to have that ETF in the portfolio. I did have it at that time. Right. Another thing, we don't buy direct those ETF. We get them through the South African providers, which introduces a layer of fees. For example, if you want to track the S&P 500, you can just buy the Vanguard VTI or VOO. The VTI has a total expense ratio of 0.03%, which is very low. And then the VOO ETF, you can get it for 0.1%. But if you buy another ETF, let's say, for example, you get one from Signia that tracks S&P 500. The total expense ratio is a bit high. Even the distributions, they do not correlate with the distribution if you were to buy that ETF directly. So that is why I prefer to have them there. But like I said, it can lead to underperformance. So you have to make your own informed decision there where you would like to have those ETFs there. So what else is missing? Okay, I'm interested in knowing what ETFs do you have in your portfolio. Any ETF that you have in your portfolio that maybe you're invested in, please share it in the comment section. Or if you would like to recommend that I consider a certain ETF, make sure that you also recommend it there. There are some interesting ETFs, like maybe it's a momentum ETF, preference share ETF, or maybe it's even a dividend ETF, right? Like I said, what I'm trying to avoid is to over diversify, and I'm also trying to reduce the overlapping of these companies. Remember, the top 40 ETF, it has the top 40 largest companies. But if you look at the resources ETF, most of the mining giants, in fact, all the mining giants are there. Some of those giants, you find them in that Satrix top 40. So that's a double exposure. You also look at the banks. Some of the big banks like Standard Bank, it's there in the financials ETF, and Standard Bank is also there in the top 40. Then you look at these companies, the resources, they are paying nice large fat dividends. Sometimes they include special dividends. So now if I buy those dividend ETF, for example, I still get the dividends because those companies, they pay large dividends. But those companies, they are there in the sector specific ETFs, and they're also there in the GSE top 40 ETF, right? So that's one of the reasons why I don't have plenty of ETFs. The other thing is the amount that I can invest in that tax-free savings account, not the 36,000 limitation. But for example, if I have 10,000 rand in the top 40 ETF, I get more ETFs as opposed to if I take the 10,000 and I split it in many different ETFs. Yes, they can come with distributions, but if you combine the distributions from all these different ETFs, then they don't add up to a lot of money. it could be discouraging. Some people are comfortable with that diversification, but my view is that the ETF is already diversified, so I'm not looking to try and diversify it again, right? So that's it that I wanted to share with you. The tax-free savings account that you need to max it if you can. Don't exceed the 36,000, otherwise SARS is going to tax you at 40%. And then just to share what is in my ETF portfolio. If you enjoyed this video, make sure that you like it and you share it. Please bring comments. I'll be happy to read your comments and to respond to them. If you haven't subscribed to this YouTube channel, please consider subscribing. I will see you in the next video.